prices for gas and food. So let me ask you this, Chair Powell, with all of that in mind, what is the basis for the argument that wages are too high and that they need to come down in order to rein in inflation?
So it isn't that wages themselves are too high, it's that the rate of growth of wages is not consistent, and I'll explain this, not consistent with 2% inflation over time. So, of course, it's great when wages go up, and we want them to go up. We want people to get strong wage increases, but at a certain point, wages become high enough that companies start raising prices, and you wind up getting high inflation. So if you just kind of reverse engineer what level of wage increases would be consistent with 2% inflation over the longer term, today's wage increases, if you look across the numbers of measures that we look at, they're significantly above that. Now, there's some evidence that they're flattening out, particularly average hourly earnings. There's some evidence that measure of wages is flattening out so that it's no longer going up. So it's really not about reducing wages. It's just having a more sustainable pace of increases.
And what would you expect if wages started to stabilize, as you say, they stop increases? How long would you expect it to be before the prices that consumers are paying would start to go down?
So
are they ever going to go down?
It depends in prices don't have to go down for inflation to go down. So if prices remain at the same level, inflation goes to zero. But it depends on different businesses. In some parts of the service economy, labor costs are a very large portion of costs, and so you would think that gets passed through very quickly into prices. And so we would think we would think that pass through should be shown fairly quickly in some parts of the economy, in others less so. But over time, we would want wages to be moving up at the highest sustainable rate that's possible, right, and consistent with 2% inflation.
And of course, at the same time, the economy, we've got this very, very strong labor market, but simultaneously, we continue to see higher unemployment rates among African Americans, for example, nearly double the unemployment of white Americans. So how do you see this sort of interplay between wage growth and what the Fed actions to cool demand on that underlying issue?
So we don't target wage growth, of course. Our job is price stability.
Right.
We look at wage growth because over a long period of time, it's an important factor in determining price stability. So that's really how we think about it. In terms of the disparities, we saw those disparities increase significantly at the beginning of the pandemic and then reverse. As we pointed out in our monetary policy report, those gaps have at least returned to historically lower levels. There's still gaps, though, and those are not really gaps that we can get at with monetary policy. But we point them out because they're an important aspect of our economy, and we do consider them as we think about appropriate policy.
I think I would agree with you. I think that those are sort of systemic challenges in our economy that need to be addressed through the policy that we work on here. It seems to me that I think we have a labor supply problem in this country, and we should be dealing with that in Congress in terms of what we need to do to make sure that people have the skills and the capacity to do the jobs that our economy is creating. But it also seems to me that as long as wage growth is lagging inflation, that in some ways labor costs are actually dampening inflationary pressures because they're not keeping up with inflation. So I think it's just an interesting and complicated issue.
No argument there.
Yeah. Well, I just have a couple of minutes left. I'm not going to have a chance to get into this, but I'm quite interested also in this, that what we're seeing around the country everywhere, and especially in Minnesota, about extraordinarily high increases in housing. The Fed is raising interest rates, which is going to have an impact on increasing housing prices because mortgage prices are going to go up and other costs going up in terms of building housing is going to go up. So I'm just I'm interested in how you sort of weigh that dilemma.
So, after the pandemic, for a number of reasons, housing demand went way up. Rates were low, but also people decided they wanted to live more in housing, single-family homes rather than downtown. And so prices went up all over the country at very, very high levels. Now you see the housing market slowing down because you see higher rates are having an effect. That should have an effect on housing prices, perhaps even fairly quickly, so that prices won't necessarily come down, but price increases will flatten out. We're seeing lower home sales, we're seeing lower starts, so we're seeing a slowing in housing. And, ideally we would, the very low settings of rates during the pandemic were appropriate, but part of what that did was it supported a lot of demand for housing. Maybe we're going to get back to a place where supply and demand are closer. I will say, I agree with you on the labor shortage issue, which is a longer term issue that we have, but also with housing, there are constraints on housing construction, so that it's very possible that we'll be in a position where there isn't enough appropriate housing at the right price, and that's a longer run issue. Again, not so much for us as for you.
Thank you.
Thanks, Senator. Senator Lummis of Wyoming is recognized.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being with us today. It'll come as no surprise to you that I want to focus on digital assets in Fed master accounts. So my first question is about the accounting treatment of digital assets, specifically SEC Staff Accounting Bulletin 121. So this bulletin requires publicly traded companies, including banks, to hold digital assets in custody as an on-balance sheet liability. So will the accounting standards contained in this bulletin that requires it to be on balance sheet be applied by the Federal Reserve to banks and bank holding companies?
That's something we too saw that and understood the implications, and I think that's something we're working on with our fellow bank regulators. And I don't have an answer for you though, but that's certainly something we're focusing on very closely right now.
And I would note that the Basel Committee on Bank Supervision has declined to establish a capital charge for custody digital assets because they're always off balance sheet. They've created a framework called the Prudential Treatment of Crypto Assets that continues to acknowledge that they're off balance sheet. So if the standards of the SEC's staff bulletin are adopted, that would be the first time that custody assets are placed on balance sheet. Do you think it's smart for the U.S. to be imposing bank standards beyond international norms?
So again, I mean, that was the SEC has authority over accounting rules, and that's what this was. And we now have to consider that exact question, and that's what we're doing. I can't really say more because we are working our way through it. But my understanding of it is the same as yours, though, which is custody assets are off balance sheet, have always been. But this is, the SEC made a different decision as it relates to digital assets for reasons it explained, and now we have to consider those.
Yeah, and thank you. I encourage you to consider that and appreciate that you're looking at it and you're aware of it. That's great. So I'll turn to master accounts now. Of course, the board and the reserve banks have refused to provide Congress and the public with transparency with regard to the application process. At its core, a master account is a public benefit conferred by the Fed to a private institution. And since a master account is a public benefit, really doesn't the public have a right to know which institutions have master accounts and which have applied for accounts and not received them? Both the FDIC and the OCC publicly list similar application information on their websites today. So could you commit as part of a transparency project to make publicly available a list of institutions that have received master accounts, as well as the institutions that have applied and not received them?
So I'll be glad to look into that. You know our system well, and it really is that the Fed, the board, we set rules, but the reserve banks really make the decisions about granting accounts subject to those rules. And we actually think we can improve on that system with the current proposal we have, and are considering comments on that right now, as I'm sure you know very well.
Yeah, and as you also know that applicants for master accounts are getting whipsawed between the Federal Reserve Board of Governors and the banks, that one says that the Federal Reserve says that the banks have all of the authority they need, meaning Federal Reserve Bank of Kansas City and others have all of the authority they need to make these decisions. And yet you go to the reserve banks and they say, oh no, we're waiting for the Board of Governors. And so there's a whipsaw effect and we get no answer. The black hole continues to exist. And, you know, my frustration level has long since been at a boiling point. It continues to be at a boiling point. There's no responsiveness. It's a black hole. And I wish to just once again use this opportunity to encourage you to address that. There's just no excuse. There's no excuse anymore, Mr. Chairman. Thank you.
Thank you, Senator Lummis. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman. Welcome, Chairman Powell. I can't let an opportunity go by without raising the issue of the FedNow real-time payments system implementation. You would agree that if we can get this system into place, it will save millions of Americans billions of dollars, would you not?
Yes, I would.
And so that's why I just want to encourage you to move very quickly. As you know, the system is scheduled to go up next year. We had an earlier hearing in May in this committee, and Brookings Senior Fellow Aaron Klein, who's spent a lot of time monitoring this system, shared his concern that we weren't moving fast enough to hit that date and fully implement it. So I just want your commitment, Mr. Chairman, that you are focused on this and that it is a priority.
Very much so. We're very focused on doing it right and also on time. And that's next year.
Right, because it especially impacts, of course, people living paycheck to paycheck, right, who make a deposit in a bank, but it doesn't clear. And then they get tagged with all sorts of overcharge fees and things like that. So I just, you know, other countries that are a lot less advanced in terms of technology, the United States have figured this out, and we should be there now. I just want to turn to really the issue of the day, which is this challenge in navigating between keeping a strong economy moving and low unemployment and dealing with price stability. On the good news front, and I think you've testified to this earlier, the United States is doing a lot better than our sort of near peer economies when it comes to economic growth and quickly reducing our unemployment rate. Isn't that the case?
Yes, generally, we're further advanced in our recovery, I would say.
Yeah, so that's good news, and we want to keep that going. We also obviously want to deal with the price increases, and you know the concern, which has been shared by others this morning, is that many of the causes of those price increases are beyond the control of the Fed, and I call them the 3 Ps: Putin's war, pandemic supply chain disruptions, price gouging. Senator Cortez Masto raised that. And so I think the challenge is, how do you navigate increases in interest rates when a lot of the drivers of price increases are beyond your control? And I want to raise a specific kind of case study here, which is in the housing market. Because you would agree, would you not, that increasing the supply of housing can help reduce housing prices, right?
Sure.
Yeah. But what we're seeing now is that with rising interest rates, obviously new investments are more expensive. We've seen housing starts fall by 14% in May. So that means fewer housing opportunities, less supply, fewer workers engaged in building new homes. So if you could just use that as a sort of case study of how you're going to navigate these cross currents.
So interest-sensitive spending is a very important aspect of how our tools work. And in the case of the housing market, what you're seeing is higher mortgage rates. So you're actually seeing demand move down quite significantly. Many indicators suggest that fewer people are visiting homes. The wait time for selling a home is increasing. Housing sales are moving down. Housing starts are moving down. And overall, it's a slowing in the housing market. And I think what you will see, or many forecasts call for the increase in housing prices to slow pretty significantly now. You've seen very, very large, as you know, increases in housing prices over really since the beginning of the pandemic, and to the point where, you know, all over the country you have housing, you know, people, you know, 5 bids above the ask the second the house comes on the market. Well, that's cooling off now to a more sustainable pace. So what we hope is we can get demand, that part of the economy, to slow to a more sustainable pace, and get the housing market back on a more sustainable path where there's a better balance between supply and demand.
I appreciate that. I'm just going to use my remaining time to sort of push you a little further on this issue, not specifically with housing, but given the fact that so many of the factors that are driving price increases are beyond our control, and you talked about core inflation, what is your confidence level that we will have what is generally referred to as a soft landing, where we won't overcorrect in raising our interest rates to the point that it begins to really hurt our economy, workers, and wages? What is your level of confidence that you can navigate a soft landing for the economy?
I mean, it is our goal. It is going to be very challenging. It has been made significantly more challenging by the events of the last few months, thinking there of the war and you know, commodities prices and further problems with supply chains. And the question of whether we're able to accomplish that is going to depend to some extent on factors that we don't control.
Well, Mr. Chairman, if I could, but this is the point I think many of us are making. The factors that are out of your control are not going to be susceptible to those costs being brought down: oil, gas, I heard you earlier, food, by the measures you're taking. And the risk is that the measures you're taking will slow down other parts of the economy without getting us the benefit of lower prices. So I think that is a big theme today, and I just look forward to continuing our conversation about how you're going to thread that needle.
Can I say that the other risk, though, is that we would not manage to restore price stability, and that we would allow this high inflation to get entrenched in our economy. And we know from history that will hurt the people we'd like to help, the people in the lower income spectrum, you know, who suffer now from high inflation. That will hurt them more than anyone. So we can't fail on that task. We have to get back to 2% inflation so that we can have the kind of labor market that we really want.
I appreciate that, Mr. Chairman, but as you know, the prices that people are experiencing most vividly day to day is the price of gas at the pump and the price at food at the grocery store, both of which are things that you've said are beyond your control. So thank you, Mr. Chairman.
Senator Daines from Montana is recognized for 5 minutes.
Mr. Chairman, thank you. It's good to see that here today. Like my colleagues, I continue to be deeply concerned with the inflation we're seeing in the economy and its real-life impact on Montana families. When I go back home, I hear the top 3 concerns from Montanans. It's inflation, it's inflation, it's inflation. It's the price of gas, it's the price of groceries. CPI inflation grew 8.6% year over year in May, the highest increase since December of 1981. In Montana and other mountain states, as you're aware, inflation grew by 9.4% versus a year earlier. This rate of inflation is unsustainable for Montanans and Americans alike. For months, Republicans in Congress and even some Democrats, like former Treasury Secretary Larry Summers, warned of the massive inflationary risk of the $2 trillion March of 2021 stimulus package, what that posed the economy. In fact, just pulled up the Washington Post article from March 29th, 2021. I remember being in this very room, similar hearings, warning our colleagues about the risks of moving through a $2 trillion spending package when we had $1 trillion of unspent COVID money still remaining in December of the prior year. Let me quote from that Washington Post article. It says, Summers, of course, now remember Secretary Treasurer Clinton and economic advisor to Barack Obama, a Democrat, Summers, age 66, who drafted economic blueprints for the past two Democratic presidents and was a top candidate to lead the Federal Reserve Board under President Obama, has emerged in recent weeks as the loudest critic of President Biden's approach to reviving the pandemic-era U.S. economy. The Harvard University professor who advised Biden for a time last summer warns, and this is key, that the president's stimulus plan may trigger the highest inflation in more than half a century and could cost Democrats the chance to make lasting investments in the economy. There were many of us warning the administration and our colleagues across the aisle of blindly moving forward on a purely partisan basis to jam through that $2 trillion package and the inflationary risk associated with it. Now, with inflation at a 40-year high, these same Democrats are continuing their ill-advised effort to revise President Biden's sweeping Build Back Broke package, no matter the warning signs that are flashing right now in all of our faces. Chairman Powell, Mr. Summers has suggested several years of greater than 5% unemployment might be necessary to contain inflation. Would you agree with that assessment?
I guess I would say that I don't want to comment on other forecasts generally, but my assessment is that it's going to depend to a significant extent on factors like how long does the war run and how long does it take supply chains to improve and that kind of thing. There's a lot of uncertainty around that. I would have a lot of humility about trying to, predict with any clarity exactly where the economy is going to be in, the next 3 years, for example. But my assessment, though, is that there's certainly paths to get inflation down to 2% with outcomes that are substantially less, troubling than what you just read.
You've characterized a soft landing as getting back to 2% inflation while keeping the labor market strong. What's your confidence that the Fed can achieve this goal without causing a recession?
So I think that is our goal. That's our intention. I think it's going to be very challenging. We've never said it was going to be easy or straightforward. It's going to be challenging, and the events of the last few months have certainly made it more challenging. And nonetheless, there are pathways through which that could happen. And in particular, what we saw in the early part of 2021 when inflation went up was very strong demand surged against what were unanticipated supply-side constraints. And the result was prices went up a lot, much more than could be explained by just the increase in demand. And so in principle, if demand can move back down, then inflation could move back along that path just as quickly as it went up. In principle, no one's guaranteeing that, but the idea is this is not the same. There are relationships in the economy for how quickly inflation would move compared to demand moving. This could be an unusual situation because we have had what is in effect a vertical supply curve where there isn't any more supply or a very steep supply curve. So you get really sharp increases in prices. You could get sharp declines for the same reason. So that could be a difference. And I think we'll find out, ideally. But ultimately, we need to see progress on the supply side. And we're not waiting for it. Our job and our tools work on demand. And that's what we're working on now, is getting demand down to a more sustainable level so that supply can catch up and is in better balance with demand.
Chairman Powell, thank you.
Thank you, Senator Daines. Senator Ossoff, on behalf of the chair.
Thank you, Senator Tillis. Mr. Chairman, welcome back. Let me state at the outset, you have an extraordinarily challenging job in extraordinarily complex times, and much of what you are responding to and adapting to is beyond your control. Your success is the country's success to a significant extent. It's the world's success, and I fervently hope for your success and appreciate your continued efforts. I'd like to ask you to specify, if you can, what transmission mechanisms you believe are most sensitive right now to the change in monetary policy, what forms of consumption you expect to be most sensitive to it, and the extent to which you anticipate that some of the effects that you hope to have on aggregate demand through the increase in rates are transmitted via financial markets, and if so, how?
So I guess I would say three basic channels through which our tools work. The first would be interest-sensitive spending. So that's durables, including cars and things like that, durable goods, housing, for example. So when rates go up, spending on those purchases, which tend to be financed with debt, will be restrained. That's one major channel. The second is just asset prices generally across the economy. When interest rates go up, it raises the cost of holding assets. It can cause assets, again, broadly across the economy to either moderate their growth or decline somewhat in value. And that has an effect a broad effect across the economy on spending on everything. The third channel is really the exchange rate, which you can think of as another asset price, but that also has the effect of pressing down on inflation. So we look at all of those. Starting with the first one, you can see we just talked about the housing market. The housing market is the classic part of the economy that's very sensitive to interest rates, and you're going to see a moderation in housing demand. You're going to see declining or slower increases, at least, in housing prices. So those are the three main channels I would point to.
Let me ask about in terms of asset prices and how financial markets are responding to the Fed's stance. I've consistently asked you and Secretary Yellen when you appear before the committee to talk about systemic risks, risk to financial stability, risk of financial contagion. Where you're moving swiftly and markets are volatile, there are perhaps institutional trades that could rapidly unwind or exotic financial instruments that no longer function well. What do you anticipate to be the parts of capital markets now, or the phenomena in capital markets that present the greatest risk to financial stability as the Fed takes the aggressive action that you're taking?
Well, I'd start by saying that the banking system is very strong, well-capitalized, highly liquid, does a much better job of understanding the risks it runs and managing them than before the global financial crisis. And that's a reflection of the work that regulators did and that the banks did too. So that part of the financial system is critically very strong. And we saw that through the pandemic, and we see it now. To your point, though, capital markets did show real periods of illiquidity during the immediate aftermath of the pandemic. And so we've been looking at ways, I say broadly, the regulatory community has been looking at ways to address that.
So you remain concerned about money markets?
Well, that's a different, so money markets that's a part of the economy where it has become illiquid because the assets that they were invested in were not able to be turned into cash quickly to fund depositors wanting to take their money back. So we stepped in and had to provide that liquidity for the second time. There are reforms going on there at the SEC which should address that, and they're in the process of being considered and then implemented. So that should help on that front. I was thinking more of the Treasury market, for example, which it became illiquid at the very beginning when people wanted nothing but cash, nothing but the cash and most cash-like things. Treasury market has been functioning, though, all through this period when we've very significantly changed the stance of monetary policy. So markets have been functioning well, reasonably well, and
okay, my time's running short, and appreciate that. We'll probably follow up to talk a little bit more about financial risk. With my remaining few seconds, let me ask you this. How would you characterize the share of responsibility, if you will, on the supply side versus the demand side for the elevated price levels over the last year? To what extent do you believe that, you mentioned the supply curve being steeper than expected, and so the increased durable goods demand and consumer demand having a greater than expected effect on prices. Right now, is the principal driver of the increase in the price level elevated consumer demand, elevated demand, or is it supply constraints? I know we're facing both, but I'm asking you to allocate, as you can, some share to each phenomenon.
Yeah, I just would say it's clearly both factors are principally at work here. You couldn't get this kind of high inflation without strong demand, and you certainly couldn't get it without the kind of supply issues that we've had both in the labor market reflected in high wages, and then in the goods market reflected in what's happened with durable goods. And cars in particular, you look there, it's been driven by semiconductor shortage.
Thank you, Chair Powell. Thank you, Mr. Chairman.
On behalf of the chair, Senator Moran.
Mr. Chairman, thank you. Chairman Powell, thank you for your presence here today. Let me start just by making certain that I tell you something that I think I need to say on behalf of Kansans. I've never seen the level of anxiety, uncertainty, concern for the future as I see today when I have conversations with folks in my neighborhood and across Kansas. There's a sense that something's not right. Inflation is a significant component of that feeling, and the inability to know what's around the corner is terribly damaging to folks, both financially but also mentally or psychologically. There's a real circumstance out there that I want you as the chairman and your colleagues to know exists. It is, I think uncertainty and what the future holds is one of the most damaging things when people try to figure out their lives and how comfortable they are. I also want to highlight a particular Kansas, but middle America, across the country, issue of agriculture. I was on a farm on Saturday, participating in, observing harvest of wheat. We live in a world in which people are starving, and more are going to starve if we are unable to, if we fail to get more grain into markets from Ukraine and from Russia, but from the United States as well. Agriculture, farming is a noble calling, and it has a lot to do with being able to feed people who are now desperate. Part of the concern in regard to agriculture is the interest rates have a significant consequence to the profitability, to the survivability of producers, and profit margins get squeezed if interest rates continue to climb. We face declining or lower land values. That creates greater access to credit challenges. Tell me how you see, one, how I can assure my Kansans that and Americans that things are going to be better, and two, how can I assure farmers and ranchers that their future will be brighter based upon the activities of the Federal Reserve?
So I take the sort of very low confidence readings that we're reading about and your comments about Kansas citizens as being pretty directly related to high inflation. And I think people haven't seen it. You know, most people, you and I, are old enough to remember what it was like. And it's, you know, it's something that it just really does destroy public confidence in the economy and that kind of thing. So we need to get inflation back down to 2%. And all I can say is we're using our tools to do that. And the public should believe that we will get inflation back down to 2% over time. Again, there are factors that we don't control, but those factors do tend to wash out over time. Things like commodity prices don't tend to just keep going up. They may remain high, but they're quite volatile over time. That's what the record shows. So we're doing what we can to get inflation down, the parts that we can address. So for whatever that's worth, that's what we can do and what we will do. In terms of the agricultural patch, as you know, we have, including your Kansas City Fed president, we have some terrific people who are Reserve Bank presidents who give us a good sense of what's going on in the agricultural sector on an ongoing basis. And it's obviously a very, very difficult time with fertilizer prices and difficulty in getting all kinds of inputs. And it's just a very challenging time in the agricultural world. We do understand that. Our part of it is to do what we can to get inflation back under control. I know higher interest rates are painful, but that's the tool we have to moderate demand and get demand and supply back into balance so that inflation can come down.
Mr. Chairman, in a conversation you and I had on the phone, you indicated that, as you did today, there are certain aspects of inflation that you have little control over. One of them, I think you mentioned, was energy. Let me be reassured, if you would, that there that there will not be actions by the Federal Reserve to make lending to fossil fuel producers a component of the policies of the Federal Reserve. That when you say you have little to do with it, you could cause great damage if you decide to go down a path that was at least contemplated by a number of nominees for the Federal Reserve Board. And I would love to be reassured that's not a component that you would pursue, and that we would not see resulting increasing a cost of fuel as a result of federal policy, Federal Reserve policy.
In my view, and I think the view of my view certainly is that it's not our job to allocate credit to or against or away from any particular sector of the economy. That's a job for elected officials or for markets, but it's not a job for the Federal Reserve, which has a mandate to pursue maximum employment, price stability, a well-regulated banking system, and a sound payment system.
Mr. Chairman, thank you.
On behalf of the chair, Senator Warnock.
Thank you very much, Mr. Chair, and thank you, Chairman Powell, for being here again today. Georgia is in a serious housing crisis, and the Federal Reserve Bank of Atlanta has designated owning a home in Atlanta as unaffordable to the average home buyer. But it's not just a city problem. It's urban, it's rural. Haralson County, a county with a population of less than 30,000, is also rated as unaffordable. In the midst of this housing crisis, the Federal Reserve Bank, which has a tough mandate and a tough time of managing inflation, has raised the federal funds rate by 0.75%. This means mortgages are about to get a lot more expensive for families. Chairman Powell, as the Fed raises its interest rates, what is the Fed doing to prevent this rate increase from further exacerbating the housing crisis?
Well, so by raising rates, we're clear. What you're seeing is a slowing housing market now. You're seeing because of higher interest rates, mortgage rates have gone up pretty substantially, and you're seeing a slowing in the housing market. And that should mean, one of the things that should mean is that housing prices should stop going up at such remarkably rapid rates. Since the beginning of the pandemic, we've had, a very, very hot housing market all around the country. And, what should take place is as demand moderates demand for housing moderates for new and existing homes, you should see prices stop going up quite so fast. You're also going to see fewer home sales and just generally a lower rate of activity in the housing market. So really what needs to happen is housing supply and demand need to get back into better alignment. And the part of that we can control is really by moderating demand so that prices stop going up quite so much, and that we can get back to a housing market where supply and demand are. Now, we don't control supply, and there are issues in this country around housing supply. It's harder to get land and lots and things like that. It's harder to get people to work. So there are supply side constraints. If you meet with builders from around the country, they will tell you that we have a longer term issue as a country around creating enough housing supply. That is not something that the Federal Reserve can do anything about, but it is an important issue.
Right. Notwithstanding that, mortgages are clearly, at least in the short term, are about to get more expensive. And it seems to me that what would be helpful is if the Congress would pass my Down Payment Toward Equity Act to help first-generation home buyers afford their first home. What effects do you expect the Fed's interest rate increases will have on let me put it this another way. The Federal Reserve helps enforce the Fair Housing Act and the Equal Credit Opportunity Act. What plans do you have to ensure that as interest rates increase, everyone still has access to a fair, reasonable price mortgage?
So the higher interest rates don't change our very important obligations under the fair credit laws that we enforce. And so we'll continue to enforce those, transparently and aggressively. It is true, though, that mortgage rates have gone up, and that will slow down demand, and that will be there's some pain involved in that for people paying higher mortgage rates, and also some people will be priced out of the mortgage market. But that is ultimately what needs to happen if we are to get back to price stability, to a place where people's wages aren't being eaten up by inflation. Right. So the greatest pain would be if we allow this high inflation to just continue.
I guess
we'll be right. Yeah.
Right, and I guess my point is that in the meantime, the folks who are on the margins of the marketplace in the first place, the issue is how do we protect them as much as possible. Related to that, when Secretary Yellen was here, she stated that the Federal Reserve needed to not only be skillful, but she said, quote, lucky to ensure, quote, a soft landing. I don't like counting on luck when the economic safety of Georgians, particularly those at the margins, is at risk, which is why I'm doing what I can here in the Senate. I've introduced a couple of bills to lower the price of gas, to lower the cost of groceries and other everyday goods, to cap the cost of insulin and other medication. And I've held the White House accountable to pursue investigation of price gouging of ocean carriers. And I've supported bipartisan legislation addressing the same issue that just became law. How can Congress lower costs for Georgia families? And what steps can Congress take to support the Fed and ensure a soft landing?
So I guess I'd be reluctant to give you advice while we're trying so hard to do the job that you've actually assigned us, which is to get inflation back down. But I think those are authorities that those of you who run for elected office have, and we don't have as mere appointees. So that's really up to you.
But you would agree that the folks at the margins of the economy are feeling the most pressure and pain, and that has to be addressed.
I think that's always the case, and in the case of inflation, it's really that if you're spending every dollar that you're intaking on the bare essentials of life, and the cost of them goes up 10%, you're in trouble right away. Right. Whereas middle class people and people better off than that, they've got some resources, some ability to deal with it. So that's why it's such a priority for us to get on top of inflation before it does become entrenched. Inflation's only now been around for, it really didn't start until March of last year. So it's not at all too late for us to get this job done and get back onto the kind of path we all want to be on.
Thank you so much. I'm concerned about this, and it's why in the meantime I've introduced several bills to lower the cost for essential items like gas and groceries and medication. Thank you for your testimony.
Thank you, Senator.
On behalf of the chair, Senator Sinema, I think, will join virtually.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for joining us today. And congratulations on your recent reconfirmation. The inflation numbers continue to be concerning, and this is the #1 issue I've been hearing about from Arizonans. Families and small businesses are paying higher prices, and they need relief from soaring inflation so they can make ends meet. But we also know that this is not only a U.S. problem. Countries around the world, both big and small, are also seeing high inflation. So how is the U.S. position relative to other countries with respect to inflation?
I'd say our level of inflation is broadly comparable to that of other major economies. You saw Canada released their inflation number today. It's not far from where ours are. Same with the Western European democracies and the United Kingdom. But they're different compositions. So I would say generally, to generalize, in the United States, our inflation has more of a demand-driven component, whereas in Europe, it is more, to a greater extent, driven by very high energy prices, for example. Although in the United Kingdom kind of has a mix of both of those. We also have high energy prices here. So the levels are similar, but the composition is a little bit different here in the United States.
Well, thank you. Crypto markets have experienced substantial volatility in the past several weeks. Has the Fed been tracking these events, and what implications do they have for how the Fed is viewing the broader economic outlook and making decisions with respect to monetary policy?
We are tracking those events very carefully, of course, and not really seeing significant macroeconomic implications so far. And But I think the principal implication is really what we've been saying and others have been saying for some time, which is that in this very innovative new space, really there's a need for a better regulatory framework that treats, the same activity should have the same regulation no matter where it appears. And that isn't the case right now, because a lot of the digital finance products are in some ways quite similar to products that had existed in the banking system or the capital markets, but they're not regulated the same way. So we need to do that. And I think that is the main takeaway I would have.
What is an appropriate proportion of current U.S. inflation to assign to Russia's illegal invasion of Ukraine? And how are you thinking about these events in the context of setting monetary policy?
Well, I would say that, the increase in commodity prices are clearly connected to the war in Ukraine. So that part of inflation would be certainly much lower than it is without the war in Ukraine. And there's nothing that our tools work on demand, and there's a job for our tools to do here. There is a job to moderating demand so that it can be in better balance with supply. But it wouldn't. We don't think that we have the answer to higher oil prices, due to the global oil situation.
I know the Fed tracks the core personal consumption expenditures index closely when thinking about monetary policy. Many trends in our economy, including a big shift towards technology and e-commerce, accelerated during the first year of the pandemic. And it's possible that the indicators and weights used to measure inflation may need to be revised to accurately measure inflation as Americans are experiencing it. So we all know inflation is high, but how high it is matters to ensure that we have an appropriate response. Congress and the Fed should make decisions based off the best information that most accurately reflects the challenges that families and businesses are facing. Have you given thought to this issue?
Well, yes, in the sense that we look very carefully at the way we measure inflation in this country. We actually use personal consumption expenditures, which is a little different and a better approach, we think, than the more traditional consumer price index. This was a change we made about 20 years ago, and I think economists generally think that PCE inflation does a better job of measuring the inflation that people are actually experiencing in their lives. So that is what we do, and we keep it updated. The government agency that manages it keeps it updated on a regular basis. So we think that's the right approach in terms of measuring inflation. Of course, we look at CPI as well, but we've chosen to make PCE inflation our principal measuring stick.
Okay, thank you. Mr. Chairman, I see my time's expired. I yield back. Thank you.
Senator Menendez of New Jersey is recognized. Thank you, Mr. Chairman. Chairman Powell, I want to start on the issue of diversity at the Fed. I have a letter that we sent you yesterday and signed by 9 senators, including 5 members of this committee, urging you to undertake a number of simple reforms to the process for selecting bank presidents and Class B directors. That process has to include meaningful transparency and public engagement if we are ever going to have Fed leadership that truly represents the public as required by the Federal Reserve Act. So I'll wait for your written response, because we just sent that letter, on the details of those proposed reforms. But for now, can I have your commitment that you'll provide us with a substantive response by July the 22nd?
Yes.
Thank you. And also, will you commit to work with me to put in place real, meaningful changes to the process so we can have a broader array of voices to the Fed leadership?
I'll commit to having a frank discussion with you about that and what could be. We're open to ideas of how to improve. As you point out in your letter, it's not like we haven't made tremendous strides as it relates to the B and C directors in the course of the last 10 years. We really have. And the diversity numbers are, I think, quite impressive for the B and C directors. The A directors, as you point out in your letter, less so, but those are appointed by the bankers in the district. But we can have this conversation.
Well,
I look forward to it.
Less so, but it's worse than less so. I mean, you don't have one bank president in the history of the Federal Reserve who's been Hispanic. That's far worse than less so.
I was talking about directors, but
Yeah.
you're right about that. I accept.
And there was a tremendous opportunity, and it didn't happen. I just continue. I feel like I'm the lone effort on this, but 62 million Hispanic Americans who represent $2 trillion of domestic purchasing power deserve a seat at where some of the most important economic decisions are being made. So we look forward to the engagement that you've said that you're willing to engage in. Now, I am trying to find out, as others have raised with you, there's no question that painfully high inflation is affecting every family in America. But in order to develop the right response, we need to understand the underlying factors that are driving price increases. I think you've said here today that Russia's invasion of Ukraine, pandemic-related supply chain issues are perhaps, and the energy issues that flow from Russia's invasion of Ukraine are perhaps some of the biggest factors in driving inflation. But the question is, how is it that raising interest rates on those underlying causes of today's inflation ultimately are going to change it? You know, energy is still energy. Supply chain is still supply chain. Russia's invasion of Ukraine is a continuing challenge for the world, but there's nothing about interest rates that's going to affect any of that.
No, but notwithstanding that, there are major parts of the economy where the demand exceeds supply meaningfully, and that's where our tools have a job to do, where we can moderate demand and give supply time to recover so that supply and demand get back into better balance and inflation comes down.
Well, it seems to me that we can all recognize that raising interest rates is a blunt tool at the end of the day. But I'm looking, going back to the beginning of my questioning, it's essential, I believe, to be mindful of the effects that your actions, your meaning the Federal Reserve, will have on unemployment, particularly for those groups that were hit hardest by the pandemic. The Fed's latest monetary policy report states that, quote, employment for blacks and Hispanics not only declined by more than that for whites and Asians early in the pandemic, but also recovered more quickly since the end of last year. Now that we're potentially entering a period of larger and more frequent interest rate increases, what do you expect will happen to the unemployment rates of black and Hispanic workers relative to the population as a whole?
Well, it'll depend on what happens to the overall unemployment rate. And you know, our goal is to achieve 2% inflation while still keeping the labor market strong. That's our intention with this.
Well, I appreciate what your intention is, but I would venture to say that what we will see is what we have seen in the past, that crisis after crisis disproportionately harms Americans of color. So I hope the Fed's response to inflation doesn't continue that trend, because it is woefully wrong that one group of Americans disproportionately faces consequences of policy decisions versus the rest of America. And this is another reason to have people at the Federal Reserve who represent this community to share those insights with the Fed as you determine these macro policies that are going to affect our communities disproportionately.
Thank you, Senator Menendez. Senator Tillis.
Thank you, Mr. Chair. Chair Powell, in response to a question from Senator Warner and a question from Senator Sinema, Senator Warner more or less asserted that we're all in the same boat in terms of inflation globally, but you made the point on two different occasions that what's driving inflation in largely Europe, a little bit less so in the UK, has to do with spiraling energy prices. Could you talk a little bit about, beyond the pain at the gas pump and the increased cost of transportation, how increasing, and I should say, and I believe that Europe is where they are, this is not for you to comment on, because they moved a little bit too aggressively and didn't look at resiliency with some of their energy inputs that were largely affected by the Russia invasion. But could you talk a little bit about the other commodities that are affected by rising interest rates? We're talking about housing, and we know that pipes, a number of inputs to housing construction, have gone up. Can you talk a little bit more about the market basket of other commodities that are influenced by increasing energy prices?
I think energy prices go into an awful lot of different places in the economy, including, you know, as an input into manufactured goods of all kinds, and plastics particularly, things like that. So it does you know, it's a big contributor to inflation, not beyond just the actual energy prices.
Yeah, and so my only comment here, and then I just have a closing thought, is that we are unilaterally hamstringing your ability to bring inflation down. You don't have to respond to this, it's a policy position, by artificially increasing the cost of energy in this country. If we simply would recognize that there is a way to get to a transition to green renewable energy and make the glide path sustainable, we could easily separate ourselves from the rest of other Western democracies with respect to that tool, which is not in your toolbox. And hopefully we can get to that discussion and embrace the idea that the transition is inevitable. It's a matter of timing and resiliency in the meantime. Just one other question. I know the post-FOMC press conference, you ruled out a 100 basis point increase. Is that a long-term view or a view based on the circumstances as you see them today? In other words, would that be something potentially on the table if the measures that you're taking right now do not work out?
I think I would never take something off the table for any and all purposes. You know, the committee that I chair will make whatever moves it believes are appropriate to restore price stability. Okay.
Well, I for one, am glad you're at the helm. I have a lot of confidence in you, which is why I voted for your confirmation. But we will be submitting some questions to the record back on the points that I made in the opening statement about transparency. There is some frustration, and I have to say it's bipartisan in terms of questions that we're asking and not getting answers to. The master account is one of them, but there are other items that we'll just include for the record. Thank you, Chair Powell. Thank you for serving.
Thank you, Senator Tillerson. Thank you for your cooperation in this hearing today, and a busy day for a lot of people. And Senator and Chair Powell, thank you. I have a series of questions. I have not asked my questions. I was saving them for last. But and then after my questions, we'll adjourn. You've said that Russia's aggression in Ukraine, port congestion, and COVID lockdowns in China especially have contributed to higher prices. Consumer spending continues to be strong. Most Americans probably worry about inflation. Talk for a moment, if you would, about the strengths of the American economy now and whether or not you see positive signs of prices stabilizing.
Well, consumers are overall, not every consumer, but overall the consumer sector is in very strong shape financially. There's, as you know, a very substantial accumulated quantity of savings on balance sheets. Less so at the very bottom of the income spectrum, but right across the rest of the spectrum. And so that's there to support spending even in the face of higher inflation. And you're seeing consumer spending hold up pretty well. Sorry, the rest of your question.
Well, are there positive signs of prices stabilizing?
So in terms of prices stabilizing, you know, what we're looking for is, you know, compelling evidence that inflation is coming down, and we don't have that. So nothing I could point to says that we have that. I will say that core PCE inflation is a pretty good indicator of where underlying inflation is running, and it has moderated over the course of this year reasonably significantly from where it was in the latter part of last year. Still way higher than it needs to be. We need to see a lot more progress. but just it's been running at a rate over the last, say, four or 5 months that is lower than it was, at least. But again, still far too high. So we're looking for that. We're not really seeing it yet. There are lots of stories out there of how this should happen, and some people think it's very clear that it will. And until we actually do see it happen, we need to keep moving.
And I want to be clear from your comments publicly, your comments to this committee today. You say the economy is not at the point of a recession, correct?
I don't see the likelihood of a recession as particularly elevated right now. You should know that no one is very good at forecasting recessions very far out. No one's been able to do that regularly. So, but I would say that the U.S. economy for now is strong, and spending is strong. Consumers are in good shape. Businesses are in good shape. Clearly, financial conditions have tightened, and you're seeing growth slow from the very elevated levels of last year associated with the reopening. You're seeing the beginnings of job growth slowing to more sustainable levels. And there's risk in that. There's obviously risk in that. Monetary policy is famously a blunt tool, and there's risk that weaker outcomes are certainly possible, but they're not our intent.
And as I said at the beginning of my testimony, or my opening statement, that a couple hours ago, that our economy is growing faster than China's. Let me ask a few simple questions about gas prices. We've heard a lot today about gas prices from both sides. Just a few yes or no's. Does President Biden set gas prices?
No.
Does Congress set gas prices?
Not as far as I know.
Do you, as chair of the Federal Reserve, set gas prices?
No.
I wouldn't ask you to assign a sort of quantum responsibility, but starting with the decisions of OPEC and the world's major oil companies to not produce more, can you tell the committee briefly what goes into the price at the pump, and ultimately what tools you have, Congress has, other government agencies have to bring the price down?
It's really principally the price of oil, which is set globally by the actions of largely by the actions of large oil-producing countries, and then it's the refining spread, what it costs to refine, and what the refiners can charge before the public consumes that refined product. So those are the two pieces of it, and we don't have really, our tools certainly don't work to address either of those things.
Let me talk for a moment about housing. Several have asked about the skyrocketing costs for both renters and aspiring homeowners. Prices over the last 2 years, but prices weren't that great prior to President Biden and the last administration either, we know. Last year alone, rents went up more than 11%, grew faster than wages. What are the short-term and long-term effects on inflation in our economy if renters see more and more of their monthly income going to housing?
That will crowd out other kinds of spending, and that's the very fast increases in housing prices over the last couple of years have been very broad across the country and unsustainably high.
And that, of course, speaks to the importance of building more housing. Last question I want to ask before adjournment. We've seen cryptocurrency values collapse by some $2 trillion, and markets crash over the past few weeks. Consumers losing money, workers losing jobs. The Monetary Policy Report highlighted the risks of stable coins, digital assets that aim to maintain a stable value in order to trade cryptocurrencies. Talk for a moment, if you would, about the financial stability and monetary policy risks that these assets pose, and how are stable coins different? In your answer, include how stable coins are different from the U.S. dollar, which has the full faith and credit of the United States behind it.
A stable coin is an instrument really that is backed up in it. There's a reserve that has securities in it that are meant to assure the value of that of let's say it's $1 stable coin. So it's meant to assure that your interest is actually worth $1. So that sounds a lot like a money market fund, for example. And the way money market funds work is there's great transparency about what's in the reserve and their requirements about what must be in the reserve in order to preserve that $1 value. The world of stable coins is new and emerging, and it doesn't have the sort of fit-for-purpose regulatory scheme that it needs to. And I think that's something you've been hearing a lot across the board from a number of federal agencies and from our own Treasury Department, which has been leading an effort to try to put in place. And many members of Congress now have proposed new frameworks for regulating stablecoins and digital assets generally, and that seems like a wise thing.
And you don't, clearly SEC, clearly CFPB, other agencies, the Fed's role in regulation of cryptocurrency, in your mind, is what?
Well, that's one of the issues, is who really does have authority over this, and that's something Congress would need to clarify. We have authority over what banks can and can't do, some banks and bank holding companies. The SEC has some jurisdiction over securities. The CFTC has relevant jurisdiction. So part of this will be sorting out, deciding what these things are and how they should be regulated. There are stable coins that are really used in connection with the crypto trading platforms. That's most of what happens now with stable coins, but there are also some stable coins and even more potentially that will be used in payments broadly. So that would be two different kinds of regulation there. It's just an area where Congress and Congress is investing bandwidth and looking at proposals and something like, and that's, I think, a healthy process that should lead over time to something that has bipartisan support and puts in place appropriate regulation for the whole area.
Let me drill down for then my last question. What if Congress doesn't act on? I understand that the Commodities Future Trading Commission understand what you said about SEC. Is the Fed directly involved in any of these regulatory actions regarding cryptocurrency, absent Congress action?
Just we regulate banks, regulate and supervise banks, and so we have a say in what our banks, the Federal Reserve regulated banks and bank holding companies do with crypto assets on their balance sheets, what activities are permitted and that kind of thing.
Does that
of course,
suggest,
the OCC is at that table, and so is the FDIC.
Does that suggest that a number of American banks are cautious because of your oversight of them on crypto?
I mean, American banks are are now very much exploring, are there profitable opportunities to serve our customers in this new space? And of course, what we're doing is saying, let's be sure that takes place in a way that preserves and supports safety and soundness. And we've had a ongoing set of meetings and collaborations with the FDIC and the OCC. And that's ongoing, I guess, between us and the OCC. So I think that's an appropriate way to carry it forward. But it's not a substitute for what I think is it's not like it's like any other major area of innovation. Ultimately, Congress will come together to create a regulatory framework that is more fit for purpose for it, as it has in so many other cases.
Okay, well, thank you, Mr. Chair Powell. Look forward to continue working together. For senators who wish to submit questions, those questions are due 1 week from today, Wednesday, June 29th. To Chair Powell, please submit your responses to these questions for the record for no more than 45 minutes.
And so concludes today's hearing before the Senate Banking Committee. We've been listening there to Sherrod Brown, the chair of that committee. We've heard Fed Chair Jay Powell testify here for some long time about what's going on with the economy overall. He started right out at the beginning and said that at this point he anticipates further rate increases, although he was not very specific about when or how many, but further rate increases so that they can really adhere to the mandate of Congress to ensure stable prices at a time of real inflation. At the same time, Chair Powell was very careful to say he thinks the economy is strong in many respects, and he thinks it can withstand it. When asked directly about the possibility of recession, he said that it was a possibility. He allowed us how it was a possibility, but at this point, he does not see the chances of that as elevated and certainly doesn't see it as inevitable. To take us through what he heard in this testimony, we welcome now Michael McKee. He's Bloomberg International Economics and Policy Correspondent. So, Mike, what did we learn today?
Not a whole lot. And if investors were expecting the chairman to lay out much more detail on a path for interest rates, they've got to be disappointed. At the very end of the hearing, Chairman Sherrod Brown asked him about the possibility of a 1% move, and he said they don't anticipate it, but he's not ruling it out. That may be the most informative remark he made all day. He also said that the Fed is going to have a tough time getting to a soft landing, but they think they can do it. And as you mentioned, a recession isn't imminent, he suggested. It is a possibility rather than imminent. Higher rates are painful. He admitted that, and they said there is not much more the Fed can do because that's its toolbox is higher interest rates at this point. He said the Fed is going to try to bring down the rate of wage increases, but not bring down wages. Their goal is to cool the economy and not destroy demand. Pretty straightforward hearing, David. There wasn't a lot of questions. There weren't a lot of questions that would satisfy people on Wall Street, but there were a lot of political questions, of course, about this program or that program that he might support or who is at fault for this or that. And as usual, he ducked answering those questions.
Yeah, just for our audience, particularly radio audience right now, the markets are not reacting that much. I would say the equity markets particularly. The NASDAQ is up less than 0.25%. The S&P 500 is up almost just 0.1%, very just slightly up. As the bond market, on the other hand, though, really the 10-year has been on a buy. It's up, about 11 basis points. The yield is down about 11 basis points now. So Mike, take us back through neutral rate, 2.5%. He's clinging to that position, that's the neutral rate. But he did seem to say he does think they have to go above it.
Yeah, the neutral rate is hard to know until you get there and look back at it, but their view has always been that long term it would be about 2.5%. They've admitted they're going to need to go higher than that, and if you look at the dot plot from last week, it goes up to about 3.86% at the end of next year. So that would put them well above what they consider their long-run neutral rate, and then they would look to start bringing rates down again. And you see that priced into the markets. So at this point, the markets are expecting a higher rate going forward, and then they expect it to come back down again. There's the dot plot that suggests over the next 2023, we see a peak, and then it comes down again.
So, Mike, one of the things that struck me was the discussion about the housing market, with Chair Powell really saying he does see the demand going down for housing, and at some point that could affect housing prices.
Well, there's no question that demand is going down. We've seen declines in new home sales and existing home sales the past couple of months. And of course, mortgage applications have fallen off a cliff. But the interesting thing, and we saw this yesterday in the existing homes data, is that prices have continued to rise. We saw a big drop, 3.7% in existing home sales, but the median price for existing homes hit a record high. So the question is, how long does it take the reduced demand for housing to affect prices? As long as they keep going up, that'll keep feeding into particularly the CPI and the headline inflation numbers.
One thing that investors will find reassuring is, as I heard it, we had Jay Powell say basically he thinks the Treasury market's working just fine, despite some issues there with some fluctuation last week.
Yeah, that's the one area which people have been concerned about in terms of the so-called Fed put. The Fed has made it clear they're not jumping in to save anybody's investments, but if the market cease functioning, they would have to intervene. That was the major justification for getting involved and especially restarting QE and all the lending programs back in March of 2020. But at this point, they don't see any real problems in any of the financial markets in the United States. Obviously, there are some concerns in emerging markets, but he said we have our dollar swap lines available to enable central banks to borrow and make payments in dollars if necessary. So they're reasonably saying.
are all these people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you are Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared me, you scared my children. I worked in Nissan for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn, and he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
Yeah, it's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Passi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon. I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, you know, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, you know, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, you know, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
To basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rob Posse didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you've got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's a
to
very
me.
sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness. From my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but there's this tiny...
was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now, at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they've done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now once again imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in this story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system. And you end up in sort of a race to the bottom. And that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits. And there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving. And most importantly, they've probably gotten off of one before. They've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network, that is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. And take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project, it's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the Snam model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia is very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling costs of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP. And I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
stories, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We do have the Dow, the S&P, NASDAQ all advancing. Stocks are higher after Fed Chair Jay Powell reiterated his commitment to curb inflation and acknowledged the risk of recession, as some traders now expect the central bank to closely monitor the impact of its rate hikes on the economy. S&P up 20. That is a gain of 0.5%. Dow Industrials up 134, up 0.4. NASDAQ up 67, a gain of 0.6%. The 10-year yield, 3.14%. Spot gold is up $7 the ounce to $18.40, up 0.4%. West Texas Intermediate crude tumbling 2.4%, $106.89 a barrel. We are awaiting an announcement from President Biden about a tax relief plan. We'll have that for you shortly here on Bloomberg Radio. Prices, though, for gasoline have been dropping from records amid fears of a recession and signs of easing demand. Oil company shares are lower. We've got ExxonMobil down 2.7%, BP down 2.9%, Chevron down 3.4%, EOG Resources down 4.3%, Pioneer Natural down 2.4%. Abby Joseph Cohen says the era of everything going up is over. Cohen is now a professor at Columbia Business School and a former senior investment strategist at Goldman Sachs. And on Bloomberg Surveillance this morning, she told us market fundamentals now matter more than ever.
Where it's the fundamentals of earnings, the fundamentals of margins, the fundamentals of inflation and interest rates, and putting that all together in terms of appropriate valuation models, that will make a big difference for investors going forward.
J.P. Morgan Chase is laying off hundreds of home lending employees and reassigning hundreds more this week as rapidly rising mortgage rates drive down demand in what have been a red-hot housing market. Recapping, S&P up 21, up 0.6, and that's a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers Studio in New York. Good afternoon to our audience worldwide on radio and on YouTube. It's Bloomberg Business Week on Wednesday, June 22nd, 2022. I'm Tim Stenovic. Carol Masser is out today, but joining me in her stead is Bloomberg West Coast correspondent Ed Ludlow. He's live in our Bloomberg 960 studio in San Francisco. Ed, how are you this afternoon? We've got a packed show. All right, working on getting Ed's feed up there. We're going to get him up in just a second. First, though, I do want to tell you all about the program this afternoon. We are waiting to hear from President Biden. He's planning to waive a federal gasoline tax to help Americans battling surging inflation. We're going to bring you his comments live when he does begin speaking. Stocks are kind of searching for direction after Fed Chair Jay Powell wrapped up his testimony to the Senate Banking Committee. We're going to dig into that a little bit later this afternoon. We're also talking lithium, oil, and Bitcoin. And we also go to Africa, where the NBA is looking to fuel basketball's next era of growth. We wrap up the afternoon with a focus on equality, how one bank is helping women achieve wealth equality, and we're joined by the co-CEO of the largest angel network in the U.S. that invests in early-stage women-led companies. Bloomberg Business Week is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Let's head now to the White House to hear from President Biden.
There's an 18-cent tax per gallon of gas that you purchase, and a 24-cent tax per gallon of diesel you purchase. It's a tax that's been around for 90 years. It's important because we use it for the Highway Trust Fund to keep our highways going. But what I'm proposing is suspending the federal gas tax without affecting the Highway Trust Fund. And here's how we do that. With the tax revenues up this year and our deficit down over $1.6 trillion this year alone, we'll still be able to fix our highways and bring down prices of gas. We can do both at the same time. By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief. I call on the companies to pass this along every penny of this 18-cent reduction to the consumers. There's no time now for profiteering. There are a number of other proposals by Democrats in the House and the Senate, and I hope my call for action can help move those proposals forward as well. But we can also cut gas prices even more in another way. That's why the second action I'm taking is calling on states to either suspend the state gas tax as well or find other ways to deliver some relief. State gas taxes average 30 cents per gallon. Already, some states have acted. In Connecticut and New York, the governors have temporarily suspended their gas tax as well. In Illinois and Colorado, governors delayed theirs to give families a bit more breathing room as well. In Minnesota, Governor Walz proposes using state budget surpluses to give households a rebate that will help them pay for gas at the pump or other essential needs. I'm calling on more states and local governments to take actions like these. Thanks to our historic economic recovery, which fortified state budgets that had been hurt in the pandemic, states are now in a strong position to be able to afford to take some of these actions. Now, I fully understand that a gas tax holiday alone is not going to fix the problem, but it will provide families some immediate relief, just a little bit of breathing room as we continue working to bring down prices for the long haul. Third, I'm calling on the industry to refine more oil into gasoline and to bring down gas prices. Let me explain. I know my Republican friends claim we're not producing enough oil, and I'm limiting oil production. Quite frankly, that's nonsense. Here's the truth. Just this month, America produced 12 million barrels of oil per day. That's the highest, that's higher than average under my predecessor. And we're on track to set a new record for production next year. Plus, I've added to that supply of oil by releasing a record 1 million barrels of oil per day from what's called the Strategic Petroleum Reserve. In fact, I just led the world to coordinate the largest release of global oil reserves in history, including from other countries. In total, that's 240 million barrels to boost global supply. And Republicans falsely claim that I'm blocking production on federal lands. But again, that's nonsense. Industry has more approved permits for production on federal lands than they can possibly use. That's a fact. My administration also directed the sale of gasoline using homegrown biofuels, ethanol, E15, this summer, which will boost gasoline supplies and lower the price at thousands of gas stations across America. And I welcome the recent announcement from what's known as the OPEC Plus, a group of nearly 24 oil-producing nations, to increase global oil supply. The bottom line is we are setting records in terms of American energy production. We're supplementing that supply with a release from our oil reserves. So the issue isn't oil production alone. The problem is the refining of that oil into gas at the pump. During the pandemic, some oil and gas companies shut down refining facilities. Last week, I sent a letter to the CEOs of the largest oil refining companies, asking them to work with my administration to bring refineries back online to get more gas to the pump at lower prices. The Secretary of Energy, Jennifer Granholm, and members of my team will be meeting with many of these refining companies tomorrow. And I hope they'll come up to the table with some real ideas and practical steps in the near term. And I'm prepared to act quickly and decisively on the recommendations if they make sense to address the immediate challenge in front of us and the American people. Finally, when the cost of oil does come down, we need the price at the gas stations that they charge at the pump to come down as well. For example, in the last 2 weeks, the price of oil has fallen by more than $10 a barrel. Normally, this would reduce the cost at the pump about 25 cents a gallon. Yet, so far, gas stations have only reduced prices by a few cents a gallon. Some haven't reduced prices at all. I've heard plenty of explanations from companies and economists about why it normally takes time for these price reductions to reach the consumer. I might note that when the price of a barrel of oil goes up, it doesn't take much time for the price at the pump to go up. So let's be honest with one another. My message is simple. To the companies running gas stations and setting those prices at the pump, this is a time of war, global peril, Ukraine. These are not normal times. Bring down the price you are charging at the pump to reflect the cost you are paying for the product. Do it now. Do it today. Your customers, the American people, they need relief now. So let me summarize. Today I'm calling for a federal gas tax holiday, state gas tax holiday for the equivalent relief to customers, oil companies to use their profits to increase refining capacity rather than buy back their own stock, gas stations to pass along the decree, not the decree, but the decrease in oil prices to lower prices at the pump. And together, these actions could help drop the price at the pump by up to $1 a gallon or more. It doesn't reduce all the pain, but it would be a big help. I'm doing my part. I want the Congress, the states, and the industry to do their part as well. And let's remember how we got here. Putin invaded Ukraine. Putin invaded Ukraine with 100,000 forces. Just look at the facts. Since the start of the war in Ukraine this year, gas prices have risen by almost $2 a gallon in the United States and sometimes more around the world. But it wasn't just Putin's invasion of Ukraine. It was the refusal of the United States and the rest of the free world to let Putin get away with something we haven't seen since World War II. I said at the time, siding with Ukraine during the most serious aggression in Europe since World War II, defending freedom, defending democracy, was not going to go without cost for the American people and the rest of the free world. We were going to have to pay a price as well in the cost of military equipment, economic assistance, humanitarian relief, and sanctioned Russian banking industries. Russia is also one of the largest oil producers in the world. We cut off Russian oil into the United States, and our partners in Europe did the same, knowing that we would see higher gas prices. We could have turned a blind eye to Putin's murderous ways. The price of gas wouldn't have spiked the way it has. I believe that would have been wrong. I believe then, and I believe now, the free world had no choice. America could not stand by, and the West could not have stood by, although some suggested at the time, and just watch Putin's tanks roll in Ukraine and seize a sovereign country. If we did stand by, Putin wouldn't have stopped. Putin would have kept going, and we'd face an even steeper price. And it wasn't just me. The American people understood. The American people rose to the moment. The American people did what they always have done, defend freedom around the world. They chose to stand with the people of Ukraine. We had near unanimous support in the Congress, Democrats, Republicans, and independents for supporting Ukraine, knowing full well the cost. So for all those Republicans in Congress criticizing me today for high gas prices in America, are you now saying we were wrong to support Ukraine? Are you saying we were wrong to stand up to Putin? Are you saying that we would rather have lower gas prices in America and Putin's iron fist in Europe? I don't believe that. Look, I get the easy politics of the attack. I get that. But the simple truth is gas prices are up almost $2 a gallon because of Vladimir Putin's ruthless attack on Ukraine, and we wouldn't let him get away with it. We're doing everything we can to reduce this pain at the pump now. And if those experiences have shown us anything, it's that we need to grow and harness more energy here at home. Let's lower the price of electric vehicles so we never have to pay at the pump in the first place. Major auto companies are preparing for 50% of future sales to be electric vehicles by 2030, 100% by 2035. We're already building secure supply chains to build these electric vehicles here in America. And we're investing almost $100 billion in public transit and rail. For all the studies show that it will take millions of cars off the road and significantly reduce pollution if there's a serious transportation system available. Let's keep accelerating our deployment of homegrown resources, sources of energy like solar and wind and nuclear and hydrogen and carbon capture storage, and keep developing the battery technologies so we can store that power we need when the sun doesn't shine or the wind doesn't blow. Folks, let's make sure we're never again forced to pay the price of a menacing dictator halfway around the world. We can deal with this immediate crisis of high gas prices and still seize the clean energy future. We're Americans. We can do both. We have the most qualified people in the world. Let me close with this. Even as we lead the world in defending democracy and standing up to a brutal autocrat, there are actions we can take to help American families now. We have taken them. We are taking them. The federal gas tax holiday, state gas tax holiday, bringing back refineries, putting them back online. We just have to keep going. I promise you I'm doing everything possible to bring the price of energy down, gas prices down. And I want to make sure we all work on this together. May God bless you all and may God protect our troops. Thank you very much.
That was President Biden making remarks on gas prices from the South Court Auditorium at the White House. The president saying that he wants Congress to approve a federal gas tax holiday. He wants states to approve a 3-month gas tax holiday. He said this is no time for firms to be profiteering. He also said that the Energy Secretary is set to meet refineries executives tomorrow and that gasoline prices at the pump need to come down. You're listening to Bloomberg Business Week. Tim Stenevec in New York, Ed Ludlow in San Francisco. We're very pleased this afternoon to be joined by Yelena Shuleyeva, senior U.S. economist at Bloomberg Economics. She's with us in the Bloomberg Interactive Broker studio. And Kriti Gupta, markets correspondent for Bloomberg News, also here with us in the Bloomberg Interactive Broker studio. Yelena, I want to start with you and bring you in here on the president's comments just now. Political elements aside here, that Congress does have to approve this, and that's unlikely. What does a gas tax holiday on the federal and state level actually do for gas prices and when this is a supply-driven element?
Well, it's actually very interesting you say it's a supply-driven. So because Chair Powell, in his testimony this morning, he said that in the U.S. inflation has more to do with demand rather than supply. So what was interesting...
Including energy or is core?
It was... that's what he said.
Okay.
So, and I think that actually covers everything. So, and he was comparing the U.S. situation to the situation in other countries, namely in Europe. So, I think demand here remains extremely strong despite recent, data that shows some softening. And the idea here is to cool that demand. So, in terms of what impact declining gasoline prices would have, they will reduce headline inflation. And why it's important, it's also not only because it will help the consumer, but it's also important because it will help curb inflation expectations, which, the Fed said that they are actually looking at the headline inflation now, not just core, because that is a key driver of inflation expectation. And if that becomes unanchored, that's going to be a really big issue for the Fed and for the economy.
Yeah, Senator Elizabeth Warren among those grilling Fed Chair Jay Powell earlier on the idea of whether rate hikes would bring gas prices down, and Chair Powell saying pretty simply that he does not expect Fed hikes to bring gas prices down, but sort of top of mind for the nation. Kriti, funny markets day. How are the markets digesting all of this?
Well, not
well, or actually not at all, perhaps. I think this is kind of a conversation that has been so baked into the markets, the idea that there is going to be this, I mean, politics aside, but there is this kind of political stalemate, basically, or stalemate is the better word, sorry, between the administration, between the shale industry. But also keep in mind, this is a environment in which we need that refining capacity, as you heard from President Biden. But remember, refining capacity hasn't actually been added in the United States for decades. In fact, it's been added more in China, and even that refining capacity, I believe over the weekend there was a story that even that is getting shut down given the COVID lockdown. So this is going to be a ongoing story that you hear really around the world. And actually, as President Biden was speaking, there was another headline that the Deputy Treasury Secretary Wally Adeyemo came or was going to the UAE and spoke to the Mubadala CEO, which is the UAE's state-owned oil company, as well as some of the officials there as well, the energy officials. So remember, they are actively looking for other sources of oil around the world.
Hey, to your point, Creedy, about refineries here in the United States, don't forget that Chevron CEO Mike Wirth told our own Alex Steele earlier this month that there may never be another new refinery built here in the U.S. Yelena, before we let you go, any last thoughts about Fed Chair Jay Powell's testimony to Congress earlier today?
Sure. So I think we didn't see that much of a market reaction during the testimony because we already heard from the chair last week, and he basically reiterated the same message that they're going to fight inflation at any cost, even like looking at the probability of a recession. So that means they will go aggressively. They will hike rates expeditiously by the end of the year. However, if we see some slow inflation in June and some, decline in wage growth in the June payrolls report, we may see a 50 basis point hike instead of a 75.
Interesting. And if that would happen, that would certainly bring some reprieve to markets and expectations too. Creedy, jump on in here. Just want to finish up with you and give you the last word.
Yeah, well, I wanted to also say, to look at the margins of this gas tax, we're talking about 18 cents on a environment where national inflation or natural gas prices are over $5, almost $10 in certain parts of California. So it's 18 cents on gas and 24 cents on diesel.
$10 a gallon?
There are parts of California.
All right. Apart from Big Sur, there's nowhere else in There's nowhere in California with $10 a gallon. Norway, $10.20 a gallon.
No way.
Roughly. So you have to go a little further than California. Creedy Gupta, markets correspondent for Bloomberg. Also joining us, Yelena Shulyaitova, senior U.S. economist at Bloomberg Economics. Once again, Tim Stenevec and Ed Ludlow live from New York City and California. Well, Elon Musk wants to mine it. China is scouring Tibet for it. Battery makers are crying out for it. It's lithium, the wonder metal at the heart of the global shift to electric cars, and it's in a full-blown crisis. Demand has outstripped supply, pushing prices up almost 500% in a year and hindering the world's most successful effort yet to halt global warming. We're very pleased to have with us Jack Lifton. He's a physical and chemical engineer and an advisor to One World Lithium. It's a mineral exploration and development company. Jack, great to have you with us. How are you?
I'm fine, thank you.
Well, thanks so much for joining us. Really appreciate you taking the time. Give us an idea on where you think lithium prices are going to go in this environment.
I don't see lithium prices coming down, even though major money center banks think they will, because demand is outstripping supply dramatically. Which is the reason that prices are so high. And I don't see that changing. And I also do not see a great deal of new production coming online. The production coming online in the next few years has already been accounted for in the pricing. So the truth is that there's not much we can do about increasing supply, and demand is increasing. Therefore, price is going to either go up or stay up.
Jack, it's Ed in San Francisco. Good afternoon to you. We're led to believe there's this mad scramble then across OEMs and other tier one suppliers about EV supply, right? So if that supply is not going to increase, what are the conversations you're having? What can be done for these automakers that basically want to ensure they do have the supply for when that demand curve hits a later stage?
Well, here's the issue. In the long run, only the most efficient, lowest cost suppliers of anything survive in the marketplace. That's also true of lithium. Now, the problem with producing lithium in quantity is that there are only two sources of lithium, the so-called salars, the brine deposits, which are all through the Americas, or the hard rock deposits, which are most common in Australia. So in the Americas, we have to produce lithium from brine. To produce lithium from the day you start the process to the day you finish a batch can take up to 2 years, because what you're doing is drying out an immense volume of liquid to precipitate the solids, and then extract from them the lithium. The richest brine in the world that can be commercial the brines are in either Chile or Bolivia, and they are 3,000 to 5,000 parts per million of lithium. Now, if I want 5,000 tons of lithium from a brine that contains 5,000 parts per million, I have to dry 1 million tons of brine. Now, I can't do that on the stove with the kettle, so these are done by solar evaporation. You let the stuff dry out in the sun. It's time consuming, and that makes it very expensive.
Hey, Jack. Jack, we don't have a ton of time with you, so I want to make sure to get to this. What would you say to someone who says the type of technology is changing so quickly here that there are already companies looking for ways to develop batteries without using these natural resources? So perhaps in maybe a dozen years or so, we won't have to rely on lithium to the same extent that we are today to build batteries for EVs.
You know that storage batteries have been constantly developed for about 150 years, 170 years. Anyone who thinks that, oh, gee, we're going to have something new right away is being nonsensical. And the study of chemistry, electrochemistry, has been in progress for about a century. We know the properties and characteristics of the chemical elements. Quite frankly, the best type of battery for storage, for either grid smoothing or transportation, is the lithium-ion battery. There are going to be no replacements that can give you this kind of storage level and relative inexpensiveness. So I'm sorry, I don't go along with that reasoning. The idea that disruptive or innovative technologies are just going to take over is contrary to history.
All right, Jack, let's go back to basics then. If I'm an EV maker, whether American or European, why don't I just buy a source of lithium direct, own the miner? And what kind of conversations are you having with EV makers about that tactic?
In my opinion, the EV makers are in a panic worldwide. I'll give you an example. Ford and General Motors each say they'll be producing 2 million battery-powered EVs by the year 2026. That would mean they would need each 100,000 tons of lithium carbonate to make the batteries for those 2 million cars. That would be, together, 1/3 of all the lithium produced in this last year. That's not a very likely outcome. So there's more lithium on the way. The problem is, like I said, it takes a long time to produce lithium and a long time to develop a mine. The key is technological improvement in recovering lithium from lower and lower grade sources. There's a lot of low grade sources in the world.
So Jack, who's going to pay for that then? Who's going to pay for that if it requires investment in new technology? Is it the end user, the EV makers, or is it the mining industry itself?
You're going to pay for it.
Well, hold on a minute.
Tesla just raised the price of the S, I believe, or the Y, by $6,000. General Motors just yesterday announced the increase of the Hummer EV, $6,000. That's coming from lithium cost problems. The battery is now the most expensive component in the car. It always was in an electric car, but it costs far more than an internal combustion engine to manufacture because of the cost of raw materials. And car companies can't keep this up forever. Once the average price today of an electric car in the U.S. is almost $60,000. This used to be called a luxury car. Now it's an average electric car. Unless you're willing to pay for it, you're not going to get one.
So, Jack, just in the last minute that we have with you, give us an idea of where lithium prices go. Do we see some sort of reprieve here after this run-up?
I think what's going to happen is that this run-up is going to promote more efficient production of lithium with, for example, direct lithium extraction technology now being pushed into development. The costs have to go down or there isn't going to be an EV revolution. The cars are getting too expensive.
All right, Jack Lifton, advisor and physical and chemical engineer at One World Lithium, joining us on the phone from Detroit. Jack, thanks so much for taking the time. Let's get an update on the trading day. We're about 90 minutes to the close. Here's Charlie Pellet.
Thank you very much, Tim. Here's what's going on. Stocks higher. Crude oil is lower. President Biden calling on Congress to suspend the federal gasoline tax.
By suspending the 18-cent gas tax, federal gas tax, for the next 90 days, we can bring down the price of gas and give families just a little bit of relief. I call on the companies to pass this along, every penny of this 18-cent reduction to the consumers.
You heard the announcement live here on Bloomberg Radio. Equities are higher after swinging between gains and losses as traders were encouraged by Fed Chair Jay Powell's congressional testimony. S&P up 22, up 0.6%. The Dow up 148, up 0.5. NASDAQ up 79, up by 0.7%. 10-year yield 3.15%. Spot gold up $6 the ounce, up 0.4%. But as I mentioned, crude oil down 3%. West Texas Intermediate now at 106.20 a barrel. Equities advancing right now, but year-to-date, NASDAQ and the NASDAQ 100 index are down 28%. Margie Patel is Senior Portfolio Manager at Allspring Global Investments, and she told us, says this may be a valid entry point if you are thinking about getting into the market. She was interviewed this morning on Bloomberg Television.
I think this is a pretty attractive level because the average stock is down 15, 20, maybe 30% in NASDAQ. The price-earnings ratios are more reasonable, more average, looking over a longer time period. And the question really is what companies will be able to maintain their earnings and not have sharp earnings declines from here.
J.P. Morgan Chase laying off hundreds of home lending employees and reassigning hundreds more this week as rapidly rising mortgage rates drive down demand in what had been a red-hot housing market. J.P. Morgan Chase shares up 0.1%. Recapping S&P up 24, up 0.7. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, we got a check on oil and gas stocks from Charlie just now. Also a check of oil prices, which are lower today. This after President Joe Biden called on Congress to suspend the federal gasoline tax. This a largely symbolic move by an embattled president running out of options to ease pump prices, weighing on his party's political prospects. We should note that oil prices have been down throughout the day over concerns of a possible recession and global slowdown. We've got a great voice on this. Julia Fenzeres is oil markets reporter for Bloomberg News. She joins us on the phone from New York City. Julia, good to have you with us. I want to start with the Biden news about a gas tax. Break this down for us. As I mentioned, our own Josh Wingrove and Jenny Leonard writing that it is largely symbolic. Do you see it any other way?
No, I think everyone is seeing it as largely symbolic. And earlier we were also reporting that it's quite possible that this could have an adverse effect on gasoline prices. That if you take away this tax, so it obviously helps a little bit in the short term, but when gas prices come back to normal and you put that tax back, they might actually spike higher than they did before. That's what happened in some states, including Maryland. So it really could be detrimental.
Right, and in those states, they also had loss of tax revenues, which had some, material impact to them. I'm fascinated by the oil market right now. You turn your attention away for a moment, and the story changes. We've moved from supply disruption, focus on the war in Ukraine, to recession fears, right, Julia? So talk me through that balance right now. How is oil supply? What is the narrative around oil supply, and why is the market lower than in recent days?
You are absolutely correct. Right now, the market is being driven on fear. You saw that we lost as much as $7 overnight because of varied things. First, obviously, we have been talking about a potential recession and what that would mean for demand, that might mean that demand would be lowered and therefore there would be less crude needed on the market. But also, we see that there has been lower liquidity for Brent and WTI. Open interest are now falling down to 6-year lows, and that's going to exacerbate any move that happens in the market. That's why oil really dropped those $7 overnight because there's not enough liquidity in the market to keep it bolstered. So while the fundamentals are there, while we are still in a tight market, obviously it's still driving season, it's still summer, that lowered liquidity is really going to exacerbate these big moves that we see.
And Julia, what happens when we start to see an increase in economic activity as COVID lockdowns ease, particularly in China? Will we see prices rise then? What are analysts telling you?
That's exactly it. China still hasn't been able to come back, but if China comes back, that's going to tighten the markets even more. You're going to see even less crude in the market. You're going to see, because obviously China is one of the biggest consumers. And so when China comes out of all of these lockdowns, that's going to tighten the situation even more. And we could see higher prices, but analysts are still saying that if a recession comes in, that could really still impact prices. And we may have still seen the highest prices when Russia invaded the Ukraine in late February, those highs of around $120 a barrel. We may not see those highs just yet, especially as we're exiting the summer season and the high consumption season.
Julia, I'm going to recap some of the lines from President Biden on oil. He called on the industry to refine more oil. He also gave shout out and praise to OPEC Plus and their commitment to increase supply. And Tim was talking about how, you know, a gas tax holiday, largely symbolic. There's a lot of discussion around how OPEC Plus and oil producing nations' commitment to produce more oil is also largely symbolic. And in practice, it doesn't result in more oil. Can you talk us through that one?
Absolutely. It is absolutely largely symbolic, especially because OPEC Plus, the cartel, yes, they decided to increase production quota, but what they did was they increased evenly amongst all countries in the production group. And what does that mean? That means that the countries who were not even able to make their quotas in the first place will have to have even higher quotas. So it's not like Saudi Arabia and the UAE, which have the highest production capacity and spare capacity, they're not the ones taking on this extra capacity. It was evenly distributed. So it doesn't really look like there's going to be that much crude added to the markets by OPEC Plus. And obviously it is political and largely symbolic that Biden tipped his head to OPEC because they did increase it slightly, but that's still not enough crude to add what needs to be added into this very tight market where people are coming back. They have that want to be able to drive. They want that be able to travel. They're not seeing that, and you're not going to be able to do that if there's not enough crude.
Hey, Julia, bring us into the politics of this. We saw back and forth between President Biden and executives at oil companies over the last couple of days. And I'm wondering if you could give us an idea about what oil executives are thinking with regard to the government right now. Because on the one hand, you have the president calling to lower prices, but on the other hand, you have companies that don't necessarily have the refining capacity or don't necessarily have the will to start production of new wells or get equipment going to drill more at this point because they're potentially concerned about the long-term effect of this.
Absolutely. And I think these companies are very upset because Biden was also threatening windfall tax profits. And so he's saying, please, you have to drill more. And if you don't drill more, we're going to take some of your profits. So I think that the producers are not very much inclined to give the Biden administration additional help to drill more, especially because they don't know how long these high profits are going to last. And it also takes a while to get into drilling. It's not an immediate decision. It takes weeks to be able to, one, open a new refinery or months to be able to do that and to start drilling again. So they have really been able to hold back even with these higher prices. And I don't think that they are at all inclined by the administration to help them out right now.
Julia, my old mate Julian Lee in London writing on the Bloomberg terminal that Russian oil disappears as tankers go dark near the Azores. Julian and I used to chase around Vienna in OPEC meetings, fond memories with him. But just very quickly sum up the situation of the war in Ukraine, Russian oil supply, and how that is impacting the market.
I mean, it is still impacting the market very much so because you have all of these Russian barrels. What is it? Maybe 13 million barrels a day that you do not have anymore in this market. You don't have Russian products. That's also the big thing. It's not just crude, which obviously Biden has been tapping into SPRs and trying to get OPEC to get more crude, but it's these refined products that we are really in loss of in the market right now. You don't have diesel. You don't have gasoline. And that shortage, especially because we as the U.S. and also now all of these other nations in Europe as well, they have banned Russian oil and refined products. That has really continued to exacerbate the tight market. The market was tight going into before Russia invaded the Ukraine, and now it's even tighter.
Julia Fanzaris, oil markets reporter for Bloomberg News, joining us on the phone from New York City. Julia, we love talking oil with you. Thank you so much for taking the time. Ed, you're out there in California. I owe Kriti Gupta an apology because, as our own Matt Miller wrote me, there has been a gas station back in June in Mendocino, California, where gas prices reached about $10 a gallon, though I should note the AAA says that the average in California is $6.38 a gallon right now. I know it is. Let's get to world and national news. Nancy Lyons is in Washington, D.C. Hey there, Nance.
Thanks, Tim. President Biden is looking to Congress to help ease the financial burden posed by rising gas prices. He wants them to approve a 3-month gas tax holiday.
What I'm proposing is suspending the federal gas tax without affecting the Highway Trust Fund. And here's how we do that. With the tax revenues up this year and our deficit down over $1.6 trillion this year alone, we'll still be able to fix our highways and bring down prices of gas. We can do both at the same time.
Biden also wants states to suspend their local gas taxes, and he's calling on oil companies to increase their refining. Fed Chairman Jay Powell today assured the Senate Banking Committee that the Federal Reserve Board is determined to bring down inflation and has the tools to do it. Bloomberg's Irv Chapman reports.
The Fed's policy course was questioned by Senator Elizabeth Warren.
Chair Powell, will gas prices go down as a result of your interest rate increase?
I would not think so, no.
Will the Fed's interest rate increases bring food prices down?
I wouldn't say so, no.
Rate increases make it more likely that companies will fire people. You could actually tip this economy into recession.
Powell said the goal is to bring overall demand back in line with constricted supply, and the Fed will make rate decisions based on the evidence at each meeting. In Washington, Irv Chapman, Bloomberg Radio.
The Food and Drug Administration is reportedly getting ready to order Juul Labs e-cigarettes off the market. The Wall Street Journal reports the decision could be made public as early as today. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stenevec and Ed Ludlow. Ed's in San Francisco. I'm here in New York City in the Bloomberg Interactive Brokers studio this afternoon. Ed, among the most read on the Bloomberg terminal, a scoop from our own Hannah Levitt, all about J.P. Morgan laying off hundreds of home lending employees and reassigning hundreds more this week as rapidly rising mortgage rates drive down demand in what had been a red-hot housing market.
Yeah, and the backdrop is a changing housing market, right? You know, Powell saying in his testimony earlier that the housing market is still too hot, but as rates are rising, we do see evidence it's cooling off. And look at the spokesperson statement in this and how they're trying to position this as JP Morgan being proactive, getting ahead of what's to come in that market.
Yeah, it's remarkable. The spokesperson you're referring to said, quote, "Our staffing decision this week was a result of a cyclical change in the mortgage market. Quote, we were able to proactively move many impacted employees to new roles within the firm, and we are working to help the remaining affected employees find new employment within Chase and externally." What I find interesting about this, Ed, is what comes next for other banks that perhaps do write a lot of loans and do originate a lot of these loans. Do we start to see those banks reassign and lay people off too?
Well, this is it. This is where we are in the global economic cycle with higher rates. It comes back to the consumer. You know, people that were financially stretching to make those payments on mortgages, now they're really stretching, and that probably is the concern from these banks, that there are people already in trouble and those that might cool off their efforts to buy a home.
So I wonder, Ed, if this is exactly what the Fed wants to see right now. You heard Fed Chair Jay Powell earlier today remind Americans and remind lawmakers that there are 2 jobs available for every 1 person who's looking for a job right now, and saying that the market is unsustainably hot. The jobs market, that is. So this cooling down is perhaps, not the first. We've seen a lot in Silicon Valley, but perhaps there's more to come, especially when it comes to financial services.
You know, when we hit off go on the Bloomberg at the end of the day and we head home, people always ask me, why do we care about higher rates? And you have to remember, they raise rates to cool demand, right? To stop people making financial commitments, to think again about spending money. And that definitely relates to the housing market as well.
This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks are holding on to gains. They have been swinging between gains and losses as traders were encouraged by Fed Chair Jay Powell's congressional testimony. That testimony described as less hawkish than feared. S&P up right now by 21 points, up 0.6%. The Dow is up 125, up 0.4%. NASDAQ up 76, a gain there of 0.7%. 10-year yield 3.15%. Spot gold up 0.4%, 18.39 the ounce, while West Texas Intermediate crude is down 3.4%, 105.81 a barrel on WTI. Bitcoin down 2.8%, 20,245. Lazy Boy shares are rocking higher right now after the furniture maker reported quarterly profit and sales that topped analyst expectations. Lazy Boy up now by 8.4%. Recapping, stocks higher, S&P up 19 points, a gain of 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Really appreciate it. Okay, Ludlow, you're still relishing in the win from your beloved Golden State Warriors, right?
I am, and it was a fantastic day on Monday. A parade for the ages. The sun was shining, the blue and gold. It was glittering on the streets of San Francisco.
I do love
that one out of the way.
I just love the way that you are so passionate about basketball. It just brings cheer to me. But look, tomorrow is the buzziest day of the year when it comes to professional basketball because tomorrow is the draft. A former NCAA player, though, hasn't won an MVP award since 2018. These days, the NBA is turning not to China, not to the United States, not to American colleges and universities, but to Africa to fuel basketball's next era of growth. Kim Basine writes all about it in the upcoming issue of Bloomberg Businessweek magazine. You can read it now on the Bloomberg and at Bloomberg.com. Kim is a reporter for Bloomberg News. He's with me now in the Bloomberg Interactive Brokers studio. Also joining us is Joel Weber, the editor of Bloomberg Businessweek. He's with us in the Bloomberg Interactive Brokers studio. Joel, I want to start with you. Why Africa for the next stage of growth for the NBA?
Well, NBA has a great tradition of looking abroad for talent, and you see this not only with recent MVPs, but reflections in the draft, which, reminder, that happens tomorrow. So that we're not going to see this reflected in this year's draft, but a while ago the NBA put a huge sort of priority on China and developing and cultivating talent there. That culminated with Yao. And sort of created this moment where basketball got big there. But that's gotten a little rocky, which we can talk about. But right now, the NBA sees Africa as its future. There's a new league that the NBA has helped set up there. This is a talent pipeline that we're going to see. There's already kind of a storied history there, but the relationship and the sort of that pipeline wasn't quite as developed as I think it's about to become. And what Kim found here was that the NBA is all in on this. They like what it looks like. It's already has a version of success, and it's only going to get bigger. So Kim, walk us through this because there's some noteworthy investors that are also involved. This isn't just the NBA doing this on its own.
Yeah, it's called the Basketball Africa League. That's 12 teams from 12 countries this year. They played games in 3 different places, one in Dakar, Senegal, one set in Cairo, Egypt, and another in Kigali, Rwanda. Now, there's a bunch of backing here. We have Dikembe Mutombo, all these former players, Luol Deng, Grant Hill, Junior Bridgman, Joakim Noah, and the biggest one is former United States President Barack Obama.
There it is.
Oh, yeah.
I had no idea that he was an investor.
Yeah, he's a minority owner in the NBA Africa, which is the NBA's overall operations on the continent.
Kim, let me jump in here and say, this is surprising. Like, I read your story and I thought, wow, this is a recent initiative. Why has this not happened in the past? There have been African idols in the game, right? Think about Hakeem Olajuwon in the 80s. Why is this just now gaining momentum, this initiative?
Yeah, the NBA opened its first office in Africa in 20 2010, and that was a long time coming. When you go back historically, this really started. It had its roots in the 70s when the U.S. Department of State sent over a couple Bucks players, Kareem Abdul-Jabbar and Oscar Robertson, to be like American cultural diplomats in Africa. And then in the 80s, two huge stars came out of Africa. It was Hakeem Olajuwon and Dikembe Mutombo. And it was fascinating to me how not seriously these people were taken. Like when Hakeem came over on an invite from the University of Houston, they didn't send a car to pick him up at the airport. They were just like, yeah, just get over here, we'll see. Like someone recommended you. Like, and then he got out of the car, he's 7'1", and they said, oh man, yeah, please come in here and shoot around with us and see how you do.
So who are the sort of the architects of this? We talked about the money, but who are the big proponents of how the BAL is shaping up?
This guy named Amadou Gallo Fall is the president of the BAL. He was born in Senegal, and then when he was a kid, he was recommended by someone while playing in Tunisia and ended up playing Division II basketball in D.C. So he was never a pro prospect, but he stayed in the sport. He became a scout for the Mavericks and eventually ended up working for the NBA when they opened in Africa, in Johannesburg. And since then, he's been doing all kinds of deal-making with all these African governments to build courts and start schools and training programs.
Hey, Kim, what's at stake here for the NBA? If we think about the recent history of the NBA and its efforts in China, they were looked at as really huge until just a couple of years ago when we saw that Daryl Morey from the Houston Rockets, he voiced support for those pro-democracy protesters in Hong Kong, and that really set the league back there.
Yeah, it set them back at least 3 years, right? So that happened 3 years ago, and things are just coming back around. They didn't air the finals on Chinese state TV last year, but it looks like we're starting to settle back into it in China. What's at stake in Africa is 1 billion viewers. There's 1 billion potential viewers in Africa for the NBA. They want to open stores there. They're going to start in South Africa, but you can't get people to buy stuff unless they care about basketball. And that's where this league comes in. It needs to be both something that people want to watch on television, but also a place to develop new talent that can then be ushered into other leagues like the NBA.
You know, I'm fascinated by the idea of recruitment, right? Because tomorrow night, Warriors 28th pick. And 28th pick's interesting, right? Because sometimes they don't play over the course of history. I think the Warriors have had 4 in recent history, but the last 2018 pick, who's real good, Jordan Poole, 2019, Poole party. And with that in mind, gentlemen, I open up the floor to, do we actually see this as a pipeline, as a route from an African league to the NBA?
I also appreciated your very poetic description of the win and parade out there in San Francisco after your Warriors won. Yeah, there's certainly potential for a pipeline here. You've seen so many players come from Africa, but they didn't have this like institutionalized kind of path to get there. So you would either just travel here on your own, go to an American high school, play there, and then hopefully get into college, or you go to the G League, that's the minor league in the NBA. That was all possible, but it took those big leaps in order to get there.
How good was you watched a lot of BAL basketball for this story. How good is it? Is it G League? Is it NCAA finals? Is it NBA? How good?
Well, it's not the NBA, but it's quite good. It's G League or better. It's around there.
Okay.
This is a great piece. It's by Kim Basine and Katrina Hoyge from Bloomberg Businessweek. Kim is a reporter for Bloomberg News. He's with us in the Bloomberg Interactive Broker Studio. Joel Weber is the editor of Bloomberg Businessweek, also joining us from the Bloomberg Interactive Broker Studio. Check out Kim's story, NBA Turns to Africa to Fuel Basketball's Next Era of Growth. It's in the upcoming issue of Businessweek magazine, but you can read it now on the Bloomberg and at Bloomberg.com. You're listening to Bloomberg Businessweek, and this is Bloomberg Radio.
close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. 60 minutes left in the trading session on this Wednesday afternoon. Romaine Bostic, Taylor Riggs, Katie Greifeld in for Caroline Hyde. We're joined now by our colleagues Tim Stenovic and Ed Ludlow. Ed in for Carol Master today. We welcome in full our Bloomberg audiences across TV, radio, as well as on YouTube. And 10, we're taking a look at a market here. I mean, coming off, I guess, what was one of the broadest rallies that we saw of the year yesterday. We opened lower, but we've clawed back into the green here, and I guess some of that is on some of the commentary we heard out of Jay Powell on Capitol Hill today.
Yeah, that's exactly right. And the commentary specifically with regard to what the Fed is going to do to bring down inflation. And we saw the political side of this too, with senator after senator just pushing back about the political consequences of inflation and how it's upsetting their constituents. I've got my eye on the energy sector right now because it is the worst performer in the S&P 500. This, as President Biden called for a 3-month gas tax holiday. It was down before this, though. This is the Energy Select Sector ETF. It's got large cap U.S. energy stocks. We are seeing them fall today with the price of West Texas Intermediate falling to its lowest level since May 10th at one point in the day. Now, earlier in the day, the ETF fell to its lowest level since March 16th. It's falling concerns add that a global economic slowdown is going to crimp demand.
Yeah, and the rate story, also a global story. I got my eye on the Stock 600 in Europe, and it was interesting that index in Europe down 1.8% at the session low, pairing its losses to around 0.7%, with Powell basically reassuring the commitment to tackle stubborn inflation. And we've had this conversation with guests in recent weeks about the Fed in the United States exporting inflation, global central banks paying attention, the global consumer paying attention to what is happening here with U.S. rates.
Yeah, and of course, that is what the market is pinned on. You take a look at the S&P 500, which opened lower by about 0.8% and was down more than 1% at one point on the day. And then, of course, that reversed. It was higher by more than 1% at one point. Now, split the difference, higher by about 0.5%. Similar story for the Dow, the NASDAQ, and the rest of the other major indices.
And if you look under the hood, it's still a pretty broad rally, not a perfect scorecard, but 8 sectors in the green today. You have real estate up at the top, maybe as yields take a bit of a breather. Healthcare, too, having a good day. At the bottom of the pack, like Tim mentioned, you have energy, that sector down 3.5%. Crude oil right now, if I look, it's down about 4.5%. So there you go. Materials and industrials, too, just dipping into the red in the last couple of minutes.
Yeah, you take a look at some of the individual movers here. I think it was interesting. You take a look at Apple here. I mean, kind of the big story of the day for Apple isn't just that it's higher, but it actually regained its status as the world's most valuable company on a market cap basis as far as public companies. Remember, Saudi Aramco overtook it. But of course, when you see the big moves that we saw in energy, not only today, but really over the last few days here, Saudi Aramco market cap has gone down. Apple's has gone really not up, but basically kind of held its own. And there you have it if you pay attention to those kind of things. Meta Platforms, which of course sat out the rally yesterday, largely because of some idiosyncratic